Welcome to day 14 of shop management. So, we got to talk a little bit about pay and how pay works and the legalities of pay. So, there are some documents I might be referencing as we go through this talk. The first thing we got to talk about is when you pay somebody, part of your responsibility, if they are legitimately your employee, is to withhold their federal taxes for them. Now, you can't just assume how much to withhold. You have to get a document from the employee telling you, here, how much they want you to pay Uncle Sam on their behalf. Okay? That document is called a W-4. It's a withholding certificate. That's what the employee is going to fill out and give you, and you're going to keep on file so that when you deduct taxes out of the payroll, you know how much. Now, the W-4 is going to let them pick a couple of statuses. Single, head of household, married, filing joint, married, filing single. Okay. Depending on where they're at in life, they'll fill that out on how they want to file their taxes. That's going to tell you what tax bracket they have. Now, Mr. Riley looked up these documents for me, and it was a huge help. One of the documents, again, I have the trusty iPad. One of the documents talks about the federal income tax brackets. So if you are married, unmarried, or head of household, they're going to determine how much percentage of your income that gets taxed depending on what your income is. So for myself, married couple, if together as a couple you make between $19,000 and $80,000, you're going to get taxed at 12%. But if your income as a couple goes from $80,000 to $171,000, now you're going to get taxed at 22%. Okay, and this is all for the federal government. Now, there's a couple of other taxes that the federal government's going to take out. Okay, your Medicare contributions. You're going to get 1.45% of your pay is going to get sent to Medicare. 6.2% of your pay is going into Social Security, which is the money that the government's supposed to be setting aside for when you retire. Now, that money is going to be there because you're paying into it. The problem is it going to be enough to live on? Pretty much everybody universally says no, Social Security is no longer enough to live on. That's why we have 401ks, or we have a Roth IRA, or we have one of these other types of plans to augment that income. But the chart that Mr. Riley found, and I'll make sure it's up there, probably right here, is going to cover what rate you were taxed at depending on your filing status and your income. Now, the other thing you could do is you could tell the government how many dependents you have, how many people you are taking care of. And what that's going to do is that's going to lower basically the amount that the government sees you making. They're going to assume you have to spend a certain amount of that money to take care of your dependents. And so they take that off the amount of money you made, which might lower you in your tax bracket. Okay? So Pennsylvania is going to use a very similar system. Guess what? Every state out there uses a similar system. The rates may not all be exactly the same, but it gives you the right idea. So an employee is going to fill out a W-4, and they're going to turn it into you. And that's going to determine how they get their money withheld to pay taxes. Now, that's an important point here. The reason why we do tax returns in January, February, March, usually ending in April, we've been putting money into the government this whole time. We have to settle up at the end of the year and see if what we made really was the right amount of money we should have been taxed on. If the government taxed us on too much income, then we get money back. Essentially, we used Uncle Sam as a savings account. Now, the downside to using them as a savings account is we don't get any interest. We don't get anything for Uncle Sam holding this extra money, other than we get it back. But the opposite could be true too. And especially if you're opening your own business, one of your biggest risks is maybe you didn't pay Uncle Sam enough through the year. Now you owe him and you have to settle up. Okay? But that gets set by the W-4 and then how you file your taxes. Why do you have to pay attention to that? Well, let's say you're the employee. If you go and get married, if you have a baby, or if you're an older guy like me, one of your kids is turning, or has turned 18, you need to go in and change your W-4 to reflect that. So you have one less dependent now. If you don't make adjustments as it goes along, you are either going to end up giving the government way too much money. You get a huge return, which will be great. But you basically have given Uncle Sam all this money to play with through the year. Also, if you don't go back in and adjust it for things from when you might be getting more money than you thought, like you're not taking care of a kid anymore, or you are married now, so you have dual incomes, guess what? Now you might owe. So you and your employees have to stay up to date on this. Now, one of the other things that Mr. Riley sent me, and I mentioned it in this already, was he actually sent a calculator. I know you really can't see it very well in the video, but it'll calculate for employees. You put in their name, you put in their hourly wage, their tax status, their federal allowance, which means how many withholding they get, their dependents, and then your state tax percentage, okay, and your federal income tax percentage based on the federal allowance. Then Social Security tax, which we already told you is right around 6.3, Medicare 1.45. So once you put in their hourly wage and you put in all that info, then it'll allow you to put other deductions in. These are deductions that you as a business are going to take out. Okay? Usually pre-tax, by the way. So things like your health insurance. Now, you might have uniforms that are taken out post-tax. So when you get a pay stub, you should be looking at it to make sure that the company is taking out only what they said they're going to take out, but also that they're taking out everything that they ought to be. Your 401k, your health plan. In Pennsylvania, they have a UIS, unemployment insurance, Medicare, SSI, Social Security, okay? All of these need to be coming out. And then, obviously, like I know for my pay stub, I pay for a life insurance plan. So $1 and some change gets taken out for life insurance every time. So whatever it is that you agree to comes out, you need to make sure it's coming out. But once you put that math in, all you then got to put in is how many hours did they work? Okay? Depending on how many hours they worked, it can then calculate based off vacation hours, sick hours. It can calculate what the gross pay should be. It'll calculate taxes and deductions. If there was any other deduction, like let's say you took a loan out from your employer. Some employers will let you do that. Let's say that they had a special program where you could buy tools that for a week through your employer. Might be there. They might do a special deduction because you took a loan out of your 401k. Whatever the case may be, they'll process through your gross pay, your taxes and other deductions, and then any other deduction above your normal ones, and that'll give you your net pay. So the information on the W-4 is what you use to get to that number. So it is important that you're able to go through, see both from an employer standpoint, because the worst thing that you could have happening, well, maybe not the worst, but it's pretty high up there, it's in the top 10, is to have to fight Uncle Sam because you're not paying the taxes properly for your employees. So you don't assume. And one of the things that I hope you're getting from this, one of the ethics that I hope you're getting out of this class, is that it is your responsibility as a good employer, as a good manager, to be teaching your employees how to handle this stuff and to be staying on top of them to work with them. Remember, everything we're going through is to make sure that employee experience is great. Why? Because they'll take care of the customers. And when they take care of the customers, your business will thrive. All right? So we're going to talk about this in the class as well. But Mr. Riley sent me these. These are great info to have. We'll talk about more there, but make sure you know what a W-4 is. By the way, last thing for this video, a W-2. A W-2 is nothing more than the receipt that you get at the beginning of every year that says what was paid to Uncle Sam on your behalf for last year. So that when you go to file your taxes, you can square up if what you paid was too much and you get money back, or too little and you owe. All right? So know a W-4, know a W-2, and understand how a basic payroll system works. As you're putting this together, I hope you're having a little bit of help now deciding how much you want to pay your employees, how many employees, and what could you reasonably afford to do and still expect to pay back that $4,000 or $5,000 a month loan that it would take to start your business.